Okay, so now, uh, according to the chart, what happened yesterday, you can see that most of it stayed on the buy side. Side said there was not a lot of activity, but it did respect that region, the risk region. If you don't know what I'm talking about, then just review yesterday's video. Okay, so for today, I want to review how it should become more intuitive to you, what the directions are, and what the current target price is. What are the more likely target prices? So as you can see here, you could look from this chart and introspect inductively that the direction is, continuing to incline. You've got some support here. You've got these channels, or you can use a standard deviation line and get a statistical middle value for the price for all of these time points, these time ranges, time versus price range, and this is what it generates: an inclined slope at this price value. This means that the average price currently, according to the market activity, that we are oversold by 2,900 pips. And so what that means is that it is time to sell the US dollar. If people have been buying the US dollar, it's time to sell it. And at least target 2,900 pips on the buy side. If we zoom in more, we can see that that 2,900 pips becomes another average target that is expected around 1,380 pips. So somewhere between 1,380 to 2,900 pips is not an exaggeration for you to try to target for buying euro. Again, selling USD. United States dollar is overvalued right now. No pun intended. No pun to Trump intended. So, but if we look even further into this, you can see that there is this baseline here, which we have two trend ranges pinpointing to the same price. And that means that we've got an even stronger target there, which is at 106.32 to the current price, which is about 220 pips away. So there, in my opinion, there is a very strong attraction or very high probability for it to hit this point, which is about 220 pips away. So if we zoom in even further, but this is on the scale of months, so if we're zooming into the scale of weeks, we can now see that there's an intersection that takes place right around here, right about where, right about the time that we have right now. So each of these ranges you see here, these date ranges, these time ranges, are 1 week. So looking at about, it's right about time for it to hit this intersection, and it could hit it within the next 1 to 3 weeks. That means it could go up, it could raise in price by 240 pips within the next 1 to 3 weeks. That's what we should expect. Now, and this is zooming into time ranges where these represent days, and you can see that we don't have much support on the we don't have longer support on the shorter side, on the sell side, but we do have it as resistance. You can see here. So on the support side, on the shorter support side, we have smaller time ranges, which means that price has been going up in value. The euro has been rising in value or going up on the buy side recently. And so we have three short-term trends under the price, almost under the price. If we zoom in more, we can see that these are the three that I'm referring to. But we only have three, actually. So the support is also on the long-term very, the support is very weak, but that also means that the attraction to support is very weak. Um, okay, so resistance is very, in other words, resistance here is very strong. We've got resistance, which is very long term and very strong, but it also serves as an attraction, as an attractor. Okay, so if we zoom in even more, here is the daily range. We're currently in this time range, this 24-hour time range, and within the price range, which is at these risk reward zones. So what I see here is this zone, which is about 23 pips, and this zone, which is about 92 pips. So and then also this zone, which is probably another 92 pips, but this is out of range. So this is, as far as as the average daily range is concerned, 72 pips. This is in range, and it looks like, from a first glance, that this is the risk, a tradable risk, and this is a tradable reward. So if you wanted to sell, then you would just sell and target this, and use this as the risk. Now, counting your win losses and counting your risk reward, this would be probably the most reasonable thing to do, the most logical thing to do. If price goes on the other side of this risk, you may want to buy if it crosses this line here, and just buy to its goal to hit this, which is inevitable. This 200 pip target, right, which is inevitable, which is what I expect it to be doing within the next 1 to 3 weeks, like I said. Then that's also a good goal too. So what you're looking at is this risk zone triangle here, buying if it crosses on this side and wait for it to hit this target, or sell and for this small target here as the first target, and then this as the second target. But it's probably not going to do that. It's probably just a 1 day ADR, average daily range trade, targeting this. At best, hitting this and then using this as the stop value, or stop in reverse if you're hitting this. So that's all for that. Now, as far as the horizontal values, there was a change in polarity. Yesterday gave a change of polarity. You can see that here. We have a new polarity point, so I definitely am interested in using that. You can see a few points here. It's going to point here and a point here and a point here and a point here. So something like this, right? For range, and we are actually on the side, on that buy side of that risk to hit something else. Now I would like to reassess this since it's so close, and possibly change it to something else. See what there's other highs. We can see that there are 1, 2, 3, 4 different daily highs corresponding with that. So that looks like a good point. And then if I want to use a polarity, a couple more polarities for that, polarity points. And do I want to change anything else for here, right? So I may want to move this up a little, maybe use this, tighten this up, maybe do something like this. Okay. And if I'm using this as a target here, that looks right, but also a little too tight. You also have to remember that the age on these, if the time is very far away, here's another polarity here. Okay, you can see this high lining up with this high here, lining up with this low, so that's good. Why don't I just make it for that then? Okay, do something like this. Yeah, make it for that. Let's do that. And the reason being that this line here is this high, and this low here is this low here. It also corresponds with some other lows here. So See, there's a high there, high there, high there. Okay, so we can make it something like that. Now, if you count the risk reward, you want to make these as sharp as possible so the price is not crossing them as much. So we've got 9 pips to 48 pips, so that's clearly about 1 to 5 risk reward. And the same thing right here too, right? So if you try to make these points as crisp as possible, precise as possible, and then the risk reward gap very big, then what you're doing is that every time you're avoiding the price crossing the polarity zone, okay, so each time it crosses the zone, you can scale in to recover different losses of crossing the risk and having to redirect your trade direction, and then collecting from the larger reward gap. So in other words, your first order would be here, would be like a loss of 7 pips if you were buying, and then if the sell is fills, then you have 2 orders here on the sell, and that would give you about 100 pips, right? And the same thing with the three failed attempts, right? Let's say you crossed 3 times. So on the first one, you've got let's say you've got 9 pips on the first cross, 18 pips on the second failed cross, 27 on the third failed cross, right? So that's 27 and 18 and 9. So 27 plus 18 plus 9 is 54. But on the fourth try, you got 50 pips, I believe it is. What was it? 9 and 45 or something. Okay, it says that's 9 and 50. Okay, or let's say 8. So times 4 orders. You put in 4 orders, you got 192. So you lost 50 pips and you made 192 pips. Okay, or so that's the idea if you want to use that strategy. But you want to make this zone, this risk zone, as precise as possible, right? So you're trying to calculate, like, how can you, what's the logic that makes it, why is it that size? And as long as you can keep working on the precision of this risk zone, then you avoid crossing it many times, and you don't need to worry about scaling in so many times. This is a 24-hour market, so that's the drawback is that you have to keep watching it to know when to get in the order again, unless you have some automatic way to set up those for it to cross these price points after you've identified them. Same thing for this. We've got risk zones here. So if I've got my trading here and I expect to hit this target on the other side, then that's like crossing in here somewhere and hitting this target. If I plan to hit this target, this is 045, and 045 you can see is about up here somewhere. It's still in the reward zone, right? So as far as this trading, this would already be a successful targeted trade, covering the reward zone and target and hitting the target before this even left the risk zone. So if you see it under, if you want to use both to confirm in this situation, if you see it under this price here, then you should target this, and you also see it under this risk triangle, then that's a clear target to target one of these, either 035, just as about 035 also. But as far as the buy direction, yeah, this target will already be hit according to this strategy. This target will already be hit and is on its way right now, before it even leaves this risk zone on this other side to target this. Right, so that's all for today, and see you tomorrow. See what happens.